All right, Mr. Mayor, we're 11 running over.
Okay, sounds good. All right, we'll go ahead and call this meeting to order. It's a meeting of the Seldovia City Council, Monday, June 24, 2024. Time is 5:04 p.m. This is a work session. Topic tonight is going to be the Seldovia Permanent Fund discussion with the Alaska Permanent Capital Management Company, otherwise known as APCM. And we'll go ahead and let them kick it off. Heidi, did you have anything else you wanted to add before we let them start?
No, Mr. Mayor, I was just gonna say the lay down or the work session is in the packet with the presentation. Or the presentations in the packet with the work session, and that we have Blake Phillips online from APCM. Glad to see you, Blake.
Yeah, good evening, everyone. Hopefully you guys are having as amazing a weather as we have been having lately. Should I share the presentation? Does that work?
Yeah, that'd be great.
Okay, one sec. Everybody seeing that okay? Perfect.
Yeah, perfect.
Great. So this evening, I'm going to be going over just doing our annual strategic review. There are no recommended changes at this time. The portfolio has been acting very well, really above what the long-term expectation would be. So that's, high quality problem. But I want to walk through this because this is an important part of really how our entire investment philosophy works, is coming back with you guys to make sure that we have all of the different pieces of what your goals and restraints are, and hopes and those things, that we're optimizing this portfolio for you guys. There's no other considerations in this portfolio. So we're always, we're not going to tell you what the best investment plan is until we understand what the needs are. So unfortunately, you're going to have to go through this process every single year. Sometimes we will have recommendations, sometimes we will not. Most time, the recommendations are going to be based upon if there's any changes in what you guys are looking to have. I got some simulations for what we think this can look like going forward, 10 years with various district or potential contribution levels. So I'll just get into it. The account began management with APCM in July of 2022. At the end of May, the account was $576,000. The annualized account return is 8.69%. The strategic asset allocation is 52% risk assets, 27% risk control, and 21% alternatives. Risk assets are primarily going to be stocks. Risk control is primarily going to be bonds. And we have a more full breakdown later on. So as you can see, I was talking about, where we expect this portfolio to return over time. That green line there in the middle is where that is. And that's going to be about 7.5%-ish. And so as you can see, the 8.69% return is a little bit above that. And that is what we would expect to happen. We're going to have returns above and we're going to have returns below. But over the long term, we expect that is acting well within expectations. These two gray bands you can see here, that is where we expect in any given year 95% of the returns to be. So you can see that it has been acting well within expectations, but also I'm going to repeatedly also be negative Nelly and focus on this is in loss that we can expect could happen in turbulent times. Think COVID, we could see the portfolio down 26% in short order. That is the level of risk in the portfolio that we have to accept to earn the returns that we do. It's just super important that we're always realizing that is something that is on the table, that the portfolio can be down a lot in a short amount of time. But over the long term, that is not where it ends up. So again, you will see this slide a lot, but this is our investment philosophy: plan, analyze, implement, review. So we're in the review phase. We spent a lot of time setting up the portfolio, making sure that we had the permanent fund set up and understood for the goals what we were authorized to invest in, and how to implement it. And so we are going to continue to have, the diligent process of going over this every year, ensures that we keep the portfolio on track and adjusting to any new circumstances. I'm going to skip through a couple of these if it's okay. The purpose, and this is in code, of the fund is to preserve and trust assets of the city for the benefit of present and future generations of Seldovia residents. The goal shall be to preserve principal and maintain purchasing power of the fund. So do not let the principal go down. Make sure that we're outpacing inflation. So the long-term expected return of this portfolio after inflation is 4.6%. And so the long-term return of 6.7%, that takes into account, this is this number here. So any given year, we expect to have that 7.2%. To be even more conservative, this long-term number here takes into account the path. That's the up and, basically the volatility in the markets is going to dampen returns. And so over time, it's better to use this number for forecasting than if we take out 2.5% for inflation. That's our expected inflation for the next 10 years, which is higher than 2.5% now. And then riding out to the long-term goal of the Fed's goal of 2% over time. But to take that into account, we're using 2.5% currently. That leaves 4.2%. If Seldovia was in a position where they were wanting to distribute, to support budget or any other things, that would be the amount that could be taken out sustainably every year without the principal going down on an inflation-adjusted basis. And then finally, this is the number what I was pointing out in that slide a couple ago, that 25.5% is something that this portfolio could very easily have happen in a turbulent market condition. And the reason that I point that out is not because I have any love for losses, but it is important to note that we accept that, there is risk in the financial markets and that these things can happen over time. And that when those do happen, that we stay the course and stick with our investment plan. And it's just paramount that is understood, because if we do hit that 25.5% number some month, some week, we do not want to be readjusting the amount of risk in the portfolio at that time. That will destroy value. It is, much harder to regain what you've lost after you de-risk. So if that is a number that folks are not comfortable with, then this, now are the times to have these conversations about de-risking. This is, being a perpetual permanent fund portfolio, you have the longevity and which gives you the objective capacity to take on a fair amount of risk to seek returns. The portfolio is set up very well within the range of a lot of the other permanent funds that we manage across the state, and is completely appropriate. But again, it doesn't matter what anyone else is doing. This is about the city of Seldovia's permanent fund, and everyone should be comfortable with the amount of risk in the portfolio. We are fiduciaries for you. That means we're legally required to present to you the best options with no conflicts of interest, and we're trying to meet those goals. So you can trust that we are trying to meet those things, but the subjective element of risk tolerance is something that is always very important, and why I even am talking about it now while everything is going very well. I just want to stop there to see if I have confused anyone yet.
Yeah, any questions or comments from anyone on council regarding the numbers so far?
Mr. Mayor, if I may ask.
Yeah, go ahead, Vivian.
Yeah, I missed what you said about what is the percentage that the city could use and not touch its principal? Was that 2.5 or percent?
So this 4.2%,
Uh-huh.
that is what we would, so when, in more mature permanent funds where they're starting to draw on them on a regular basis, which is not where we have, or the city of Seldovia has chosen to go yet. We're kind of more in the growth phase.
Mhm.
But if we were, or if you wanted to draw upon the fund, you could draw in our estimate is that you could draw 4.2% while still inflation protecting the principal and keeping the principal at the level that it is.
Okay, thank you for the clarification. Thank you.
Absolutely.
Anyone else? Okay, looking good so far, Blake.
Okay. So, I know over just the last 12 months or so, and even when we started it up, we've kind of talked about, what does it look like if we potentially, have contributions into this. So we put together some wealth simulations here to kind of visualize that. So if we continue with no current distributions, in 10 years, we would expect very confidently that this portfolio would be over $1 million. The 1.1 million that you see represents the 50th percentile. The blue box represents 50% of all outcomes from 5,000 different scenarios run. So when we show these numbers to councils for planning purposes, we are very confident that you can utilize these kind of numbers as your expectations. With the low end being 0.7 million after 10 years, that would be a very hard run from here. But it's good to know where those are. But the blue boxes is where you can confidently feel that they will go. And so as you can see, and then this scenario would be run with $20,000 put in annually for the next 10 years. And this would be 50,000 over the next 10 years. Can I answer any questions about that, or if anybody would be interested in us running any numbers that are different from those scenarios? We try to present these just to give you ideas for planning, or if they're, but we can run these kind of numbers in really any different way.
So Blake, just for clarification here, so you've got no deposits, 20K and 50K. Are the deposits representative of the earnings every year, or is that in
No,
addition?
sir, that would be additional deposits.
Okay, and that was okay,
yeah.
Perfect.
The earnings, so we don't do, what we might do in, our own retirement plans of dividend reinvestments or those kind of things.
Yeah.
That's not exactly how we operate, but we do take in all those earnings and we'll allocate them to the portfolio plan. So we're not necessarily doing as simply. So this would be additional money coming in and being invested to the current strategy.
Okay, so if we ended up having from year to year, if we had some surpluses and we chose that we wanted to add that to our permanent fund and we passed a resolution doing that, then that would obviously precipitate our fund growing much faster.
Absolutely.
Okay.
And that we just wanted to kind of give a shot in that these numbers were kind of pulled out of a hat, really, as far as just to give you some ideas of what that looks like for growth.
Yeah. No, and in my mind, when I see this, the whole idea here is to get a couple $1,000,000, at least in my mind, get some substantial number. I mean, if you're gonna have the opportunity to draw and it be meaningful for a project or something, then then you can actually take some money and on a year, maybe not every year, but maybe it's 1 year or a specific purpose in mind, a specific project, and then not impacting that balance. That's just it's natural earnings because of the way the interest is compounded. It's just going to continue to grow and grow. So,
and it's and these with diligence and time, these permanent funds can really become such amazing support mechanisms for the communities. Fairbanks, obviously much larger municipality. Also, someone that we work with. This is public information, but I think it's about 130 or so million now. And they're drawing, and through a similar process where they're using it as budgetary stability, they're able to pull off $4.5 million a year right now.
Yeah, that's impressive. That's nice.
And Sitka, Cordova, both of them have substantial permanent funds that have been helped. Cordova's been able to utilize some of those benefits to redo their harbor. Sitka is putting in new seaplane stuff. It can be, a very strong tool. So I'm very glad. I'm always happy to be part of these things that can be such a strong move for the community going forward.
Yep. Yeah, no, I think it's good, worthwhile planning. And certainly if it's not, in the near future for us, it's certainly helping future generations and, folks down the line have a lot less struggles than we have. So, yeah, obviously glad to do our part here.
And Mr. Mayor and Council, if you guys ever want to see any different kind of simulations or want to talk, we can run those numbers for you, whether it's on the distribution side or the contribution side. We can always do this stuff for you. We view ourselves as your investment partner. So we just want to, plug in and be as a resource for you guys. So just let us know if you guys ever want to have any kind of conversations about, what it would take to be at any certain level. A lot of those conversations start at like, hey, what do we need to, we want to draw $100,000 a year. Where do we need to be? Or how do we get there? Those are the kinds of questions that I'm more than happy to take in and kind of give you crunch some numbers for you. So just keep that in the back of your mind.
Yeah, so in just short terms for the council, I mean, it's based on the 4.2 draw, so that tells me that you got to have $1 million in there if you want to take $42,000 a year and not take a hit. So just in round numbers, multiply that for every million, double it up. So
yep. And every year during the strategic review, we'll be coming back and revisiting this, so that you guys have a good idea of like what we're expecting on inflation and what we think that sustainable draw could look like. Even if you're not taking it, it's always good to like look at that because it gives you an idea of, where you can be when you do want to draw on that money.
Yeah. Yeah, no, that's good information.
The current asset allocation is exceeding the goals as stated in the policy right now. So we don't have any recommendations for additional asset classes. You have almost the majority of the asset classes that we utilize right now. The only one I think that you are not in is private equity, and that is more just kind of a size thing. The minimum investment on those funds is usually around $2 million. But that's a good goal to have. We'll get there. And so and if enhancing goals basically beyond what we're saying, we could increase the risk in the portfolio and up the return somewhat. I'm not pushing that right now. We are not looking, our philosophy is not to be trying to hit home runs every year. Our philosophy is trying to hit that goal with as little risk as we can. So we can, but if we decided to increase that growth target, that's something that I could bring forth, some additional risking in the portfolio. But right now, I really don't think that is really that great of a avenue. I think it's set up very appropriately. We have a slowing economic environment. We have interest rates that are going to need to come down. And so I think it's set up pretty well. But again, it's really, I think in these conversations, the number one thing I want everybody to be comfortable with is the level of risk that exists in the portfolio today. And if not, I would like to have a conversation to make sure that everybody does. Otherwise, we can bring forth, more conservative portfolios. But again, for the long time, for a perpetual portfolio, you have the ability to take a lot of lumps along the way in seeking those returns. I like to use kind of the metaphor of you pay for that return with the amount of risk you're going to take. Nothing is free. So if to seek those returns, you have to take that risk, but you need to be comfortable with it.
Yeah, I appreciate you outlining that. Yeah, I know we've had a number of discussions about, risk versus reward, right? And that's what it is. It's all risk versus reward. Myself, I like the conservative approach, not ultra conservative, but I like that happy medium. Me personally, I can accept that, that maximum or that big -25 if we had to take that hit one year due to economic times, looking at the overall possibilities and how everything's strategically, located right now within our portfolio. I like where we're headed right now. So, any other comments from council on Blake's comments here?
Mr. Mayor, if I may.
Yeah, go ahead, Vivian.
Yeah, I would concur with what you're saying. I think we've got a portfolio that's really working towards our goals as a city. And I'm very pleased with where we're at and what we're doing. And the interest of possibly at some point putting in deposits to increase our outcome at the end, that's something the council, we can discuss and see if that's something in our future. But one question to that, if you committed to making deposits annually to increase the overall, is that something you commit to so you have to do it every year for X amount of time? Or maybe I'll stop right there and maybe you can answer that.
No,
Okay.
There is no contractual mechanism where I would say you need to put $50,000 into. That is purely kind of more exhibit for if you want to, as you're thinking about it, if you do have those good years where there is a windfall or some of those things, what that can look like if you decide to use those funds to further the permanent fund.
Okay, thank you, Blake.
Yep.
Thank you, Mr. Mayor.
Yeah, Vivian, Vivian, with your just to follow up on what you were saying, that's exactly what I was thinking about. Budget time, like when we get in, for example, our police fund, right? Thinking about that, if one year we decided instead of reallocating our savings, we wanted to take 20, 30, 40, 50 grand of that and plop that into our permanent fund. I mean, just every year we could try to squeak a deposit. I mean, that just puts us ahead years, the way these things were compounded. So I think that's something the council and manager will definitely need to consider, in the years ahead here.
And another thing I want to point out, like that 25.5% drawdown during turbulent times, even with that, we would be confident telling you could draw, even that year, we would be confident telling you could draw that 4%. Like that is.
Oh, interesting. Okay.
That's how it's not, when we talk about sustainable draw levels, we're talking about through all times, not just the market being good.
Not just the highs.
Exactly. And, usually then that conversation, why can't we draw more? Because there's bad years.
Yeah.
But so even through those times, that's how we run these numbers so if you were, say, like needing to take that 4.2% every year as part of your budget, we would say you can do that regardless of market conditions. Like that is a sustainable draw level. So just to make sure I round out that and not be totally negative about it.
Yeah, no, thanks for clarifying that. I appreciate that.
Yeah. So I mean, Fairbanks with their big fund in 2022, which was horrible for everyone. They drew their full draw, and we had absolutely no problems with that because the portfolio is set to do that. And so if you operate within the constructs of this framework, it works very, very well. I don't know how much time I have. I can give you guys some color on the portfolio. I'm happy to talk about the whatever you would like to hear.
Yeah, we've got about another 20 minutes or so.
Okay.
Just kind of high level walk us through it.
Yeah, absolutely. I'll hit the portfolio real quick here. Just give you the setup on that, and then I'll flip down a little bit and hit a couple market slides, and then answer any more questions that anyone might have. So when we take those those numbers from the beginning, from the account overview. So 52% risk assets, that's where I was saying, largely equities. So you got US large, mid, and small cap equities are the largest component of that. And also it's important to remember that the US stock market is about 65% of global market value. So that is our domicile. So we would always be, oriented towards the US, but it also is where the financial markets are. And so that's an important just note for why things are set up the way that they are, because we are the market to a large extent. So the difference from what I think when we looked at this last year is we're a little bit overweight in risk assets. That's more just because the market has been strong. We're generally leaning kind of more neutral-ish in the equity portfolio. These little bits of orange you can see here, those are some small quality tilts that we have on. Because with the interest rate environment, the cost of capital is higher. And therefore, the companies who do not, as we came out of COVID, you could basically anybody who was earning revenue was getting multiples like extremely high on them. Think Peloton, Zoom, all of those guys, without much cash flow underneath. That has changed a bit, and the environment makes it harder to operate when your cost of capital is higher. So what we've done is we want to orient the portfolio a little bit more towards that quality. Those have higher cash flow and better balance sheets. So that's a piece that we're doing. But probably the biggest difference from where we were at last year is we're now pretty positive on bonds. Bonds went from something, we were at 0% risk-free interest rate about 18 months ago. Now we are zoomed up to about 5%. And what that did for us is actually has our bonds paying us now at a very decent rate. And also, probably more importantly, if we do hit turbulence and the market goes down, I have strong confidence the bond portfolio is going to help us out and be that, stalwart that we need when we do hit those times of turbulence. The reason that's super important is 2022, that did not happen. Stocks were down 17%, bonds were down 12%. And that is something that really was the worst year for a balanced portfolio in 40 years. And that was because the bonds did not, because the environment we were in, which was increasing interest rates really quick to fight inflation, it took the wind out of the sails for what we would usually expect to be the safe haven. Now, if we see that happen and interest rates were cut, if interest rates came down 1%, the bond portfolio is going to be up 10%. That's in addition to the 5% or so that we're getting paid. So it's really, I think, probably the number one thing that we've moved, and what we've moved out of is these alternatives down here at the bottom. We've been funding it from that way because that was where we were trying to get some of those defensive characteristics that just weren't present in the bond portfolio as much due to just where interest rates were at. Now that it has changed, we don't have to lean on these alternative pieces as much to get the characteristics we're needing. So that's, I would say, just kind of the biggest shift that is being occurred. The other item that I would point out is when we came into this year, we're expecting about 5 or 6 interest rate cuts. That has been, and now we're expecting 0 to 1. So that's been the big change. So we were looking to actually ramp up the bond side of the portfolio even further, which by what I mean by there is probably overweighting it more and also extending the duration to take on more interest rate risks. So when interest rates go down, we profit from it. And we've kind of delayed that a bit. And so we're not pushing given how things have been, inflation has come down, but not to where we needed to. And the economy has just been stronger than everyone expected. That's kind of been the biggest change. So the last thing the Fed wants to do is come in, cut interest rates, and see inflation take off again in the middle while we're having slowing economic growth. That's stagflation. That is the enemy of the central banks. So that is kind of what we're waiting for. They need to see the job. Like, it's kind of unfortunate, but they need to see the economy slow down before we can get interest rates coming back down again. Here is the portfolio. So this is kind of over a short period of time. The since inception, you can see 8.7 versus 9.35. So the strategic benchmark is this column in a vacuum, never changing. So that's important. And our goal is to be, we don't like to be underneath it, but we're not looking to beat it a bunch either. The goal is to have this be that is solving, or that is meeting our goals. And so if we're above it or below it by too much, we're not following this strategic benchmark. There's we're about 0.2% of this that is not evident in the strategic benchmark is the cost of the vehicles we use to invest in the market. And then the other drag that you can see really since inception is going to be alternative beta, which was a volatility dampening tool that we're using, and it just does not have a good benchmark, but we're not going to use something and not give you a benchmark. That's the number one biggest drag on the portfolio. And then year to date, really, it's not so much that as that we have been preparing for rates to go down. And so that's been a drag kind of on the bond side of the portfolio. So just a couple final comments, and then I'll be happy to answer any questions. So you can see here, this was our inflation across the globe getting out of control. They ramped interest rates. It worked, but you can see that they kind of stalled out here around 3%-ish, where we want to be at 2%. That's their stated goal. That's why they're having a hard time being able to cut those interest rates, because things have been, even though they've made, it's called a tightening financial conditions. It's more expensive to get a mortgage. And so and the economy over here has continued to do better than everybody's expected, just continuously. So you can see that the 2024 growth consensus GDP estimate was up 0.9%. Then it was up to 1.3%. And you kind of see that Europe, not so much, that has a little bit of Ukraine in it, but things have just continued to react better. And then this down here, and I'm sorry, I know there's a lot of numbers, I'm just trying to get these in, but this explains really the bond movement. So across the curve, so this is different maturity levels, different lengths of bonds have moved from below 4% to 4.5 plus in very short order. That's a very strong shift. And that is, where we're getting paid on the fixed income side of the portfolio again. That is a lot just of different things that we own within the portfolio and how they have contributed. But with limited time, I just want to maybe open it up for questions on anything I have or have not covered.
Yeah, any additional comments, questions so far?
I just have one. Personally, I'm a little uncomfortable with the 52%, and I'm just wondering, with the fact that we're going into a political election year, could we change that risk to maybe 40% and then change it back a year later after the election settles? And that would just end up costing us a lot.
So it's not the specifically. So let me actually answer that in two parts.
Okay.
We have been hearing, and you're going to continue to hear, an absolute ton about the election this year.
Yeah.
It really is not. There's not going to be a lot of fundamental material data that you shouldn't, that is incremental for the investing until we at least get closer and can understand if there's going to be any kind of policy changes and all, like the composition of Congress, not just president, but like who, who's going to be in power party wise. That will give us something where there may be some potential adjustments based off of that, but that is not going to drive the market. It is going to be inflation and interest rates. And then after that, it's going to be these geopolitical events. And then,
right. I realize you have to stay the course in these things. I get that.
Yep. And given that you're not that we're not drawing on the permanent fund right now, there's no liquidity needs. That gives the ability to, to stomach any kind of volatility prudently. Like, so if we were going into like a real volatile market environment and this was, a capital reserve fund that we knew we were going to be drawing on, we would have it set up in a much different way because we're always thinking, we always want to be taking all aspects of it in, importantly, like, liquidity. We don't want to have a bunch of risky assets where we know we're going to have to sell them. And if we're not going to leave it up to luck. So we would, de-risk the portfolio. Given that we're not even drawing on this right now, it has the ability to stomach that. And we're more than happy to have the conversation about moving it to a more conservative status if that is, the will of the council. But I don't think that is not something that we think you need to do.
Okay. And then just a couple comments to Jeremiah. I know Heidi and I have had these conversations, as our remote sellers sales tax continues to grow annually, we get a little bit more from that. The extra 2% left over from the sales tax, yearly, we could look at, there's 4 or 5 things that I think we as the council should probably look at. And, I would love to see this account be even $10 million before we start drawing on that year. And the only way to get it there is you're going to have to put some extra money in there. So I would be open to that conversation at any time. That's all I have.
Yeah, thanks, John. Yep. No, I think we're all thinking the same thing here. It's anytime we could take opportunity to add would be a good thing. And I agree. I think, I think the whole sticking and stay thing and looking at this and, it's managed almost, real similar to a 401k, when a person is not taking distributions and has earning potential and, you're going to be a little bit more risk adverse as to when, you retire and you have to count on that for distributions every single year to fund your lifestyle going forward, then you're not going to be willing to take that risk. So,
no, I'm very pleased with what it's done. I really am. It's just a big risk.
And just, even like in a soft way to even think about, because what I don't like to see happen is get excited about the permanent fund and put money in and then realize you need to take it back out. Because I think that's a really bad example just for like going forward. It needs to be memorialized that this is a permanent fund. It's not the piggy bank. It needs and so to really like consider, you could even have some kind of mechanism where you put potential permanent fund additions into an AMLIP, Alaska Municipal League Investment Pool account, which is essentially money market. And you set it there. And then maybe you have some kind of weighting limit and make sure that you didn't actually not see something that you knew you needed something from. And it sits there. It's earning some nice yields, at least right now. And then you can make the decision to move it over. So you can kind of have almost like a soft cushion mechanism to move over. All I want to see for you guys is this thing to grow, but I also, it has to be done prudently.
Yeah, agreed. Thanks for clarifying that. Any other comments or questions for Blake? Okay, do we have anybody online, Liz, that's signed up? Any comments from the audience?
No, we do not, Mr. Mayor.
Okay, sounds good. All right, did you have anything else you wanted to kind of wrap up here, Blake? We got a few more minutes.
I think I hit all the main things I wanted to talk about. But yeah, I just want to reiterate, anytime you guys want to do any or if there's any strategic thoughts where you're like, we want to, how would we make this happen? I can give you those slides of what it would take, or I can give
Awesome.
you the numbers, like whether it's contributions or if we hit rough times and you need to draw on it and you're going to say, what can we expect to actually realistically do with this?
Gotcha.
Happy. So we're here to help with that. And, there is one comment I want to, kind of talking about adjusting the risk in the portfolio. Even though we're not recommending any formal changes to the investment policy, it is important to remember that we do have discretion in this portfolio to an extent. So we could move this portfolio quite a bit based on what the current market environments are without coming back and having to get, authorized to do it. That's what these ranges are down the side. So even though we're not coming to you asking to formally let us to change the portfolio dramatically, we're moving, we're adjusting these portfolios all the time to take into account what is happening in the short term. It's just not what we talk about a lot because it's really 90% of returns come from asset allocation over the long term. And that is what we are focused on. Not market timing for elections or wars or anything like that. We want to try to make sure that we're adjusting as best we can over the time, but all of those things pale in comparison to just having the right asset allocation over the long term.
Yeah, no, I appreciate that. Yeah, I think a lot about that in my own personal 401. And when you're looking and the stock market's tanking and everyone's freaking out, and you're like, oh God, I hope someone's not having a big sell-off today on whoever's managing my money. So, you just hope there's a lot of people that are, I'm sure you guys have been through this for many, many years. You see the ups and the downs, and no panicking, and it's all of your moves are calculated, I'm sure. So yeah, with risk is the number one factor.
Yeah, I think that the day-to-day stress of this stuff should not be on you guys. That's what you have us for. And you need to just make sure that we're doing what we're saying we're doing. Or whoever your investment manager is. That's the important thing. That's what we try to arm you with.
Yeah, no, I appreciate that. And at the end of the day, I think just having this, once a year and reminding us of where we're at and how we're doing and, what's going on. I think that's good for the council as members change and the composition changes and managers change. It's good for everyone to have that level of comfort to understand, where we're at, how we got here, and what our long-term goals are. So appreciate you taking the time tonight, coming in, letting us ask you a few questions, and giving us the lowdown on where we're at. And hopefully, yeah, we'll see. You never know how things are going to go in the future here. I think everyone's a little on edge about the upcoming election, as John said, but at the end of the day, yeah, there's other factors that are probably going to be more significant than the outcome of that election, at least on day one. So all
It's gonna
right.
be an interesting year for sure.
Yeah,
as we've seemed to be running into every year lately. But
yeah.
And also just, we also, if we wanted to make a change that was not within the guidelines of the investment policy and we felt very strongly about it, Heidi would be getting her door beat down by me, saying, I need to get in front of council. We need to make a recommendation.
Gotcha.
So, we're not just, this isn't like one day a year that, there's potential changes that we're going to make. And if we don't hit that market environment on that day, that's not how it works. If we need to make a change, I will be reaching out proactively. And so just want you to know that as well.
Yeah, so if there was a fundamental shift in what you guys were seeing, you'd be yeah, beating on doors. Understood. Appreciate that. I think that helps us all sleep a little better at night. So that's good. All right. Any last minute final questions, comments for Blake or Heidi, if you had anything, anyone before we wrap it up here? Okay, looks pretty quiet. All right. Thank you, Blake. Appreciate your time this evening. And yeah, we'll look forward to seeing you again in the future.
All right. Thank you all.
Okay. Yeah, thanks. Have a good evening.
You too.
All right. Okay. All right. Well, we did, yeah, and when I did comments to the audience there, that was, that should cover what we're trying to do here on the work session. I don't think I need to do another one, do I, Liz?
No, Mr. Mayor, you do not.
Okay. Sounds good. Any additional comments from council before we wrap this one up and get ready for our 6 o'clock?
Just one more. I would like to see us have that conversation sometime, even if we were only doing 20 grand a year in there, it'd make huge difference in where we'd be in 10 years. You know, and I know we held some money out initially there, you know, even if were able to pay that back, you know, it could change the outcome of that fund. I just, you know, I've seen these accounts for many years. I've had them myself, and I've seen the amounts change wildly, you know, when there's election years. And the thing is, you got to have the guts to stay the course. It always recovers. But ultimately what ends up happening is you make a smaller earnings rate is generally what happens, but it's still always been much better than a typical savings account or a bond. You know, it's still a good deal.
Yeah, agreed. Yeah, I can just imagine if we had, you know, 3, 4, $5 million in there, that would certainly take a big load off of you know, the council and the manager's mind come budgetary season. If you were at, you know, you knew you had a sustained draw that you could plan on, that would be, you know, fantastic. Or if you didn't have to use it and you could just continue to let that grow, you know, for you know,
The ones
a
that
larger project down the road.
the ones that get, you know, would excite me would be the matching funds for these particular grants we get. You know, it'd be nice that account makes enough that you could have matching fund money from there without having to take it from the general fund.
Yeah, no, that's for sure. That's for sure. All right. Well, thanks everyone. Appreciate that. And then, yep, looks like our next meeting here will be in a few minutes at 6 o'clock. So we'll go ahead and adjourn the work session, and we'll see everybody back here in 8 to 10 minutes.
Yeah, thank you, Mr. Mayor.
Okay. Thank you guys.